This is John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, March 1. Interest rates took center stage last week, and they're likely to continue dominating the financial news in the coming days. The rise in U.S. government bond yields has been picking up steam, rattling the equity and fixed income markets. Although they're still scraping historic lows, yields have climbed steadily higher over the last 2 months because of fears that the improving economy will ignite inflation. In testimony to Congress last week, Federal Reserve Chair Jerome Powell tried to assuage investor fears. He said inflation remained, quote, soft, and characterized higher yields as, quote, a statement of confidence about the economy's health. But rising yields spooked the equity markets nonetheless. Take a look at the following table. The big question this week: will accelerating economic growth sharpen the sell-off in bonds and continue to pressure stocks? Under normal circumstances, the threat of an overheating economy would constitute bad news for stocks. But little is normal during this pandemic. Investors who are worried about inflation seem to have forgotten the horrific economic decline last year during the nadir of the COVID-19 crisis. Yes, interest rates are rising, but for the right reasons. Economic growth, corporate earnings, and private sector hiring are all expected to accelerate this year, starting in the first quarter. President Biden's $1.9 trillion stimulus package, the widening distribution of vaccines, and the lifting of lockdowns will create tremendous tailwinds for investors. As of this writing, about 95% of S&P 500 companies have reported fourth quarter 2020 operating results. Earnings have generally come in better than feared, and they're now growing after 3 straight quarters of year-over-year declines. The earnings recession is over, which means stock valuations will start to see greater justification. Stocks suffered a bruising week last week, but valuations are high and a breather was to be expected. You should rotate into sectors that are poised to thrive when the pandemic has been vanquished. Front and center among these winning sectors is e-commerce. According to the U.S. Census Bureau, e-commerce sales reached $792 billion in 2020, accounting for 14% of total retail sales, versus only 7.3% in 2015. Statista's Digital Market Outlook estimates that more than 260 million Americans will make an online purchase in 2021. Take a look at my second graphic. The e-commerce players with the most promise for investors aren't the mega-cap brand name story stocks, but the smaller tech innovators that are bringing artificial intelligence, mobility, and the Internet of Things to the e-commerce realm. The retooled economy in 2021 and beyond will favor the nimble entrepreneurial companies that enhance the consumer experience. Indeed, despite a wave of bankruptcies in dinosaur segments, physical shopping malls, department stores, etc., we've seen a record number of business startups in recent months, especially in retail. Take a look at my third table, which shows the economic calendar for this coming week. This week, we're scheduled to get key economic data that will provide further clues as to the consumer's confidence and, by extension, the stock market's direction. The most significant releases occur Thursday and Friday. Pay particularly close attention to average hourly wages on Friday, which will provide insights into future inflation. Whether inflation remains modest or flares up to a worrisome degree, one asset class will benefit regardless: commodities. Amid the conditions that I've just described, our investment team has found a raw materials miner that's uniquely positioned to prosper. Consult my article that accompanies this video on the Investing Daily website. Well, okay, that should do it for now. Please stay safe, stay healthy, and stay invested. If you have any comments or questions, send an email to mailbag@investingdaily.com. See you next week.